Good evening, and thank you for joining me today. I'm Stan Lozinski. I'm a certified financial planner with Comprehensive Financial, and today we're going to continue on our series of webinars regarding advanced estate planning techniques. And I'm going to start here by sharing my screen so we can get this going. So, just basically addressing some of the concepts that we're talking about here. In one of our prior sessions, we talked about basic estate planning. And that generally applies to just about everyone, that they should have some form of a basic estate plan. And it generally would include healthcare, proxies, living wills, powers of attorney, things along those lines. But in some circumstances, people may be needing to have something a little bit more advanced depending on how much wealth ultimately they will be transferring to their beneficiaries of their estate and so on. So we're going to talk a lot about those various concepts and how they apply in various certain situations. Now, who needs advanced estate planning? Right now, the federal estate tax exemption limit is essentially $12 million. And this has been increasing over the last decade since there was some changes in the legislation. So if you have an estate, generally in the millions of dollars, over 12 million, you could consider some of these advanced programs for this purpose. Like anything, though, it is important to understand that when you have this type of need for this type of advanced planning, you really need to engage with an attorney and a good tax advisor, as there will be many implications that apply to this. Now, some of the other benefits here that people generally look to provide for is providing for their grandchildren or even later generations. If someone owns a family business or a farm, and also if you want to donate to some sort of charities and so on. But there's also some other benefits that can be realized with regards to shielding assets from creditors, ex-spouses, heirs, and so on. So it's important to understand what the motivation for this type of planning is, and again, get the proper structure for your needs. Now, some of the basic strategies come with also trade-offs. And again, you have to really consider the costs for setting up these types of arrangements. You will need to, like I said earlier, engage with an attorney. There's obviously a cost involved with that, possibly also your tax professional to, again, get their input and help with the planning process. But also, you're going to be relinquishing control of certain benefits from the assets that you potentially would be transferring during your lifetime. An example of this would be if you had a life insurance policy that you were looking to transfer into an irrevocable trust to avoid estate taxes. You generally, when you do that transfer, you lose technical control of the asset. So you would not have access, for example, to the cash value of that policy. So it's important to understand that. And also, when you do make transfers, as I mentioned a few seconds ago, you lose control of the asset. Technically, it's in trust. There's someone else managing that asset. Usually, though, in the planning that I've done with various attorneys, we generally name trustees that would be favorable to helping with the grantors, the people that are transferring the assets into these trusts, with any needs that they have over the course of their lifetime. And we'll talk about that in a little bit. So let's talk about the federal transfer tax system. First of all, just in general, we are not going to be talking about state level estate transfer tax systems. We're just going to talk about the federal taxes here. Every state is different. So again, anybody that is out of state or in a state that maybe has a transfer tax, you should consult with an attorney in that state to understand what the implications would be, in addition to what the federal system is. So there's basically two categories here that we can talk about when it comes to transferring assets. And there's three basic taxes that we're going to be discussing. Transfers made during your lifetime may be subject to a gift tax. So again, if you're transferring an asset during their lifetime, this becomes a gift tax. If you're transferring assets after you've passed away, this is an estate tax. Again, property that's transferred at death. And then lastly, we talk about generation skipping taxes. And these generally would apply if you are looking to transfer assets while you're alive or after you've passed away down to a generation below you, one or more generations below. So it's important to understand how these strategies are designed. And again, the structure of these are really in coordination with the idea that the government is looking to collect these taxes, whether you're making transfers during your lifetime or at death. Now, this is a unified system. Gift taxes and estate taxes are unified, meaning you have one basic exemption amount, and we're going to talk about that in a second. So gifts made during a lifetime are added to transfers made at death on the estate tax return. And this simple flow chart here gives you a simple understanding of how this works. Gifts while you were alive, again, taxable gifts, they're valued of the date of the gift when the gift was made. And then on the estate tax return, they add the taxable estate value. And then again, at the date of death, that equals the total cumulative taxes, taxable transfers that are being made. Now, once all of these are added together, that's when the taxation really begins. Any taxes that are owed are reduced by any prior taxes that are made. And there are some exemptions we're going to talk about. And then the generation skipping tax, that is a totally separate tax. And I'll show you an example of that in a second. But the idea is that, you can't avoid paying taxes. There's an old saying, death and taxes are a guarantee in life. So when we start to get into some of these strategies, though, you can see how there's ways of minimizing the impact of taxes on the state, and in some cases, the ability to avoid them. Now, the federal transfer tax system, you can see it's a very aggressive tax. We're talking about 40% on the gift tax and estate tax side, and also the generational skipping tax. 40% is the top rate. It is tiered, again, depending on how much assets we're discussing is part of the transfers that are going to be made. This is going to be applied to it. Now, the federal transfer tax system, basically you have an exclusion that's available to every individual. And this has been gradually increasing over the years. 2019, it was 11,400,000. It increased over the last couple of years to 11,700,000. Today in 2022, it's 12,060,000. And this is available to every individual. Now, when we start looking at the taxes, and some of the history that's involved with this, there was in 2011, we had a use it or lose it rule, which basically meant is if you did not have assets owned between spouses that were equal to take advantage of those exemptions, you lost that benefit of the exclusion. Now everything is portable. So basically, each spouse would have the ability to access the unused portion of the deceased spouse exemptions and exclusions from their estate. So it really does help in that regard. And this is also continuing to evolve over time, but effectively you get a double exemption. And right now, as I just mentioned before, right now an individual has up to $12,060,000 of exclusion. And the surviving spouse also has the same $12,060,000. So combined, we're looking at in 2022, a $24 million exemption between the two estates. And you'll see how this can apply to any individual. Now, the gift tax system, again, utilizes essentially the same exemption amounts, but again, the taxes are calculated separately. So it's important to understand that. They're not portable. So gifts from individual spouses cannot be combined or accessed for the benefit of exclusion. Now, when we start talking about gift exclusions, right now, there's an exemption that every individual can gift up to $15,000 a year without filing or paying any gift taxes. If you're doing the gift as a joint gift with a spouse, you can go up to $30,000. If you are funding a child's 529 college savings plan, you can gift up to $75,000 if it's again combined with a spouse, doubling that amount to 150. But the gift is reported over a 5-year period. So when an individual does make a gift like this, they have to report it and average it over the 5-year period. Now, there has been situations where we've come across where a parent or a spouse or one of the parents passes away, and in the middle of that 5-year reporting period, what happens then is the remaining portion of the gift would then have to apply back to the estate and take advantage of the gift tax exclusions. So at that point, it becomes a little complicated, but again, it shouldn't trigger too much of an issue with regards to taxation. If someone wants to make payments directly to a college institution on behalf of an individual, that is not taxable at all at any amount. We typically see this with grandparents, where maybe they want to take care of a grandchild that is paying for college. They can make a payment directly to the university or college, and again, it would not be a taxable gift. And this also applies for medical payments. If an individual wants to provide support for someone going through an extremely expensive medical procedure or something like that, or treatments, they can make payments on their behalf for their medical care. And again, not impose any taxes in the process. Now, when we start talking about the marital and charitable deductions, again, transfers to U.S. citizen spouses during the lifetime of death are fully deductible, so that's not an issue. But when it comes to non-U.S. citizen spouses, they may qualify for a $159,000 exclusion. This is the 2021 rate. Again, charities can also, if it's a qualified charity, can have the full gift that they're looking to make as a fully deductible contribution at death, or for also income tax purposes while they're alive. So it's important to understand that. Now, there are some strategies, as I mentioned earlier, to minimize estate taxes. And we're just going to touch on some of them quickly here, but we're going to get into details in a second. But equalizing assets between each spouse is an important factor. Optimizing that marital deduction, which we're going to talk about, that $12 million exemption. And then there's also the ability to utilize certain trusts. There's a qualified terminal interest property trust. There's bypass credit shelter trusts, dynasty trusts, grantor retained annuity trusts, or qualified personal residence trusts. So again, we're going to talk about some of these in detail at this point, but we're going to use an example here where we have a husband and wife. Currently, the way this is structured in their estate, the husband, John, has an estate of approximately $10 million. Mary, for this example, does not have assets in her name individually. Now, we're assuming, again, unequal assets. They have, the spouse has the larger estate, taxable estate, and the spouse basically has a smaller taxable estate, and the transfers are not subject to tax because of the marital deduction. But now let's talk about, again, equalizing the assets so we can maximize that unified credit, or that $12 million exemption that the government is providing, that would give each of them a $12 million exemption. So in order to do this, we have to move assets into Mary's name. So under this scenario, we're going to move half of John's estate into Mary. So she's going to get a $5 million gift during their lifetime, and that is not going to be subject to any taxes. So basically, in the event that either of them passed away, there's no estate taxes due. Very simple, very clean. Now, assuming they have children, let's talk a little bit about this scenario. Generally, if John passed away, they would take advantage of an exclusion of, again, that $12 million exclusion, that assets would move to John and Mary's children. That would be held in trust for their benefit. The balance of the estate would go to the children, to his spouse. Again, no taxes. And again, no estate taxes would be due until Mary's passing, which again would obviously be later in life. Now, if we utilized a credit shelter trust for this purpose, what would happen is, upon John's passing, we would basically have assets transferred into a trust up to the exclusion. So originally, John had a $5 million estate. After we split the assets between him and Mary, the assets would be divided between them. John's estate would transfer into a trust, which would give spousal benefits, meaning it would provide benefits to the surviving spouse, in this case, Mary. She could have access to a certain amount of principal and also income generated from the trust for her health, maintenance, and support. From that point, the residual estate transfers to Mary, and then generally, there are certain provisions that she can access certain amounts of the assets when needed. If the children were involved in this scenario, first of all, the trust would be written for their benefit, and then ultimately it would transfer down to Mary. For her use and enjoyment while she was alive, then ultimately the children would be the beneficiary of the entire estate between John and Mary. Now, if we utilize what we call a Q-tip trust or a qualified terminal interest property trust, generally, we pass the maximum amount that we can under a tax-free exclusion to the children, and this gets placed in the trust. Basically for their benefit and ultimately to provide for the marital deduction between him and Mary. And again, the surviving spouse receives all the income for the trust for life with access to the principal according to the terms and so on. Again, generally when these trusts are designed, we use a trustee that would be very favorable to Mary so she can have easy access to the assets. Again, these are items that can be discussed with an attorney that you choose to make sure that this is structured appropriately so Mary doesn't have a problem accessing these assets should she need to. And again, the remaining assets are, included in her taxable estate, but again, she has that exemption. Remember the $12 million. So John and Mary would have that $12 million exemption. So upon her death, the assets would pass from the trust to the beneficiaries. Now, the other aspect to this is when trusts are created, and this is just a side note to all of this, and we have children that are minor children that are in the trust as beneficiaries. And again, there's a trustee that is administering these assets. You don't want a large estate transferring directly to a child at age 18. I don't know too many 18-year-old children that can manage millions of dollars for this purpose and not lose a lot of the money in the process. It's just a maturity issue. So generally, there are provisions that upon both of the parents passing, that the assets held in the trust would transfer at later ages. They would receive all the income and support for their health, education, and maintenance, and so on. But later in life, generally at 25, 30, 35 is very common, they would receive a third of the principal as a distribution, at 30, another third, and then at age 35, the final portion. But again, this is all customizable by the parents that are designing these trusts. Maybe the children are very responsible at a young age, but in general, we like to see these protections in place because, again, you as the parents would not be around. The children generally might have, bad influences around them that could cause them to lose these assets. So again, these are just some certain protections that can be built into the trust documents for these purposes. Now, another option here is what we call a dynasty trust. And again, just using two examples here of an estate with or without the dynasty trust option. Generally, a dynasty trust can survive for over 100 years and basically creates a generational preservation of the assets for all the various descendants to follow. So again, they're sheltered from any transfer taxes, but any income that is generated from the trust generally is taxable to whoever receives that income. If the income is still held in the trust itself, then it is paid at the trust level. And that typically is a very high tax rate for income tax purposes. So again, it's important to understand where the benefits of a dynasty trust would be, and if the taxation of these assets for income tax purposes makes sense versus the long-term benefits of maintaining these assets for the benefits of multiple generations. Now, when we talk about another option here, using what we call a GRAT, or a retained annuity trust, basically what it does is, as long as the assets that you're transferring into the trust uh, basically are free and clear of any taxation at that point, now what happens is these are generally appreciated assets, so there's usually a large capital gain that would be applied, but the trust itself is designed to provide income to the grantors, or the married couple that initially made the gift to the trust. This is paid out over a period of years, let's say 10, 20 years. And then ultimately, the assets would transfer at the end of the term to the beneficiaries. The transfer would, though, be subject to the gift tax, but generally at a discounted value because of the annuity payments that were being made. So the nice thing about it, though, it excludes the asset from the taxable estate as long as you outlive the terms of the annuity, meaning the payment schedule that was guaranteed as part of the process here. So if it was the 10-year period and you outlived that period, the assets transferred down to the beneficiaries. Again, it does not get included in your taxable estate. Now, looking at another option here is a qualified personal residence trust. And this is generally when someone is transferring a home into a trust. We generally see a lot of this type of planning when it comes to someone preparing for a long-term care situation or anticipation of that. Generally, what happens is the asset is placed into an irrevocable trust. The trust ultimately has the beneficiary generally as the children, but while you're alive, you retain the right to live in that home. And again, for a specified number of years, generally it can go sometimes for the lifetime of that individual that made the gift of the asset into the trust. And while you're there, you generally would be responsible for all of the expenses and so on of the home, as though you were still living there without any interruption or the trust setup. You know, it says technically that you have to pay market rent if you continue to live in the home, but generally that is designed to reflect the annual living costs to pay for real estate taxes and so on. So again, understanding some of the nuances of this type of planning is important. But the idea is that you're able to transfer generally a personal residence that may have a very high capital gain on it into this trust for the purpose. And again, transferring ultimately those assets down to your beneficiaries. Now, there's another option here, what we call an estate freeze. And generally what happens is you basically transfer an asset from yourself to another person, and that's receiving it. So at that point, you can transfer that asset over, and it basically removes it from your estate. The individuals receiving the asset pick up the asset as at the cost basis of what the original giftor or grantor purchased the asset at. So it allows, again, there is some benefits here. You transfer the growth to that other person that's receiving the property. You generally retain some control of the benefit. You can design it to generate income, things like that. And some of the ways this is designed, you'll see some examples of this, is generally with a family limited partnership, private annuities, installment sales, gift or sale, or leasebacks. So we're going to talk about these right now. A family limited partnership. Now, I generally see these types of arrangements if a family has a business that's very successful or highly appreciated real estate, things along those lines. So what we see here is you generally transfer the asset to the family limited partnership. And what happens is the grantors, you or the spouse, would generally retain a 1% controlling interest in the property. But the other 99% is going to be owned by the limited partners, which would be generally the other family members, the children and so on of those individuals. They would, though, not have any control over the assets. So the parents would technically still be able to run the business or manage the property and so on that is being put into this type of an arrangement. It works out quite well in that it also protects the limited partners from any creditors of a business and so on. And also, it allows certain types of planning where we can discount the asset itself because of the lack of marketability of the asset. Realize this asset is placed in a family limited partnership. It's like a trust. But the idea is that there's a lack of marketability, that any individual that has an ownership interest can't go out and openly sell the interest of those shares of the asset. So they're able to, for estate planning purposes, discount the value of that property. Now, it's saying, generally it can go as high as 60%, but we typically see when I've done planning like this in the past with some attorneys, it generally ranges about 20 to 40%, depending on the type of asset it is, what kind of income it generates, and the valuation. So again, very important to consult with an attorney and your tax professional to understand what the potential discounts could be realized with this type of strategy. Now, the other side of this that you have to really consider, again, why you need the professionals, is that you're at a high risk of an IRS audit when it comes to this and challenging the valuation that is being assigned to that asset. Realize the IRS understands what the value of certain business assets are, or real estate and so on. It's generally, there are formulas that can calculate the overall values. So if the valuation discount is too aggressive, you could see a challenge by the IRS. So again, very important to consult with the attorneys and your tax professional on this. Now, the private annuity strategy, basically the sellers, the two individuals selling the property in exchange for a promise to pay specific income over the course of their lifetime. So in this case, property is transferred down to the children, who are technically the buyers. They will basically turn around and pay an income for life to the sellers, you and the spouse. And again, not subject to a gift tax. Again, it's a transaction, and it removes the asset entirely from the estate. So again, very favorable tax consideration in this type of an arrangement. Now, charitable giving is probably one of the areas that we get asked a lot about, because people want to be very altruistic about benefiting organizations that they feel are going to benefit society and so on. They can be very rewarding, obviously, on a personal level, deductible for gift and estate tax purposes. So again, gifts to charities while you're alive are tax deductible for income tax purposes. So very favorable in that regard. And also, if you are bequesting certain assets from your estate upon death, there's also a deduction from the estate for estate tax calculations. So again, utilizing these types of bequests or outright gifts to certain charities, utilizing the annuity products, private foundations, things along that, or donor advised funds, can be a great strategy. Now let's talk about the charitable remainder trust option. And again, this works quite well. So while someone is alive, they would essentially gift an asset into an irrevocable trust, but that asset, if it's generating income, would pay income back to the grantors, you and the spouse, for the remainder of their lives. Once you passed away, the asset transfers down directly to the charity. And again, the charity at that point would receive the asset and do whatever they feel. But again, that asset is totally removed from that estate, and again, not taxed at all. When we look at a charitable lead trust, now these work a little bit differently. Generally, what would happen here is the charity would receive the payments during your lifetime. And after your death, it would revert back to the beneficiaries, or the trust principal that was remaining. And it reduces the value of the property based on the payment stream that was out. And ultimately, the asset goes down to your beneficiaries. So think about, if again, you had highly appreciated assets, it's placed in this trust that generates this income for the charity. based on the value of those assets upon your death, those assets would ultimately transfer down to your beneficiaries at a discounted rate. So again, minimizing estate taxes on those assets at that time. But during the lifetime, those gifts to the charity are made, and again, reducing ultimately that value of the asset when it goes down to the beneficiary. Now, donor advised funds are advertised a lot if you listen to the radio or on TV, and there's quite a few of them out there based on certain religious values or certain environmental or social governance rules. So a donor advised fund essentially is you're making a gift into a trust or a foundation, and it is created to generate generally income to the charities each year. So you could gift, let's say, highly appreciated assets like stocks or real estate. And if those assets are kicking off interest income, things like that, you can basically have money dispersed annually to these various charities under your name or anonymously. And you get a tax deduction at those levels based on the gift that you're making initially to the donor advised fund. So again, a great option. You see a lot of these advertised and promoted out there in the financial services world. Nice option if someone wants to create their own foundation. A lot of them will allow you to do this without all of the tax and filing headaches that are required if you went and did this on your own. So donor advised funds are a very favorable way to structure this type of scenario. Now, asset protection is probably one of the bigger areas that we focus on with a lot of individuals because of the vulnerability to future creditors and so on. Federal and state tax laws may provide for certain degrees of protection, but again, having the right insurance in place, property insurance, things along those lines is extremely important, but also some of the advanced strategies that we can look at. Again, holding business assets or transferring personal assets to a protective trust. And let's talk a bit about a business entity scenario. So we have a business owner here. Basically, what we like to see is, and I come across this frequently, is we have a business owner, but they own their business as a sole proprietor. So one of the first things that someone can do to protect themselves from liability would be to transfer that asset into either a corporation, could be an S Corp, a C Corp, whatever the various structure makes sense, or an LLC, a limited liability company. At that time, generally, the asset is protected from creditors if the individual is protected from creditors if the business has any liabilities that are generated in the course of their operation. So in this scenario, the creditors can only access the assets that are held in the business. They cannot go after the assets that the business owner owns personally, like their home, their savings, and so on. So again, while alive and the business is operating, the business can generate income and provide that income to the business owner. But if a creditor situation arises and they go after the business, that's all they can get is the asset inside the business. We see this typically in real estate, where individuals may have rental houses, things along those lines, or in just general business operations where they're dealing with a lot of credit matters and so on. But definitely owning the business in a separate type of entity, whether it's a corporation or an LLC, is extremely advisable. And again, builds that protection around your personal assets. Now, you can also set up a self-settled domestic trust where you name yourself as the primary and even the sole beneficiary. The trustee has discretion to distribute or not distribute the assets. Creditors can only reach the property you have a legal right to receive. So again, if you're taking distributions from the property, they can come after you in the event that the assets or the income from a particular asset comes back to you personally. But if it's sitting in the trust, generally they're not able to reach that property and it's protected. We see this sometimes in domestic situations, or if someone is looking to preserve an asset that may have some creditor issues approaching it, But if the asset or income from that asset is distributed to you, it is definitely attachable to by a creditor. So again, a different tool definitely would be a conversation to have with an attorney that is versed in this type of a setup, as well as your tax professional, to understand if this makes sense if you are facing some creditor situations. Now, offshore foreign trusts can get very complicated. Basically, you're moving assets offshore, and there are many foreign countries that are safe havens for these types of assets. If a creditor has a judgment against you personally, they would have to look to go offshore where US courts do not have jurisdiction. They may have to commence legal action in that foreign country, which can be very cumbersome and generally very expensive for them to do it. So it generally creates a lot of obstacles for a creditor to pursue these assets. So again, a way to protect assets offshore, again, consulting an attorney that would have knowledge of these types of offshore arrangements is very important. But again, another way for someone to protect assets against any creditor situation. Now, in conclusion, talking about all these situations, if you have estate planning concerns, again, does this apply to you? Do you have adequate assets that would be, realized for estate taxes and things along those lines? Do you have plans of leaving assets to children or grandchildren? Again, do you have a significant estate? Do you have interests that need protection? These are all the questions that you really need to ask yourself to see if an advanced strategy would make sense. Generally, like I said earlier, most people generally are handled very well with the basic estate planning techniques of having a will, healthcare proxies, living wills, and so on. But when you start talking about significant estates or creditor situations, these advanced strategies are, an important consideration, and you should really take a look at them. If anyone has questions, please feel free to reach out to me. I want to thank you again for your time today and wish you all the best. Take care.